This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John. Welcome back.
Good morning, Gordon.
What I wanted to do this morning, John, was to talk about another presentation that was made at this conference in Berlin. We've talked about the presentation that George Soros made and the one that Richard Koo made. There was, I think, some 40 that were presented. But the other one that I found of particular interest was the one that was made by Joseph Stiglitz, and I'm sure he's no stranger to a lot of our listeners. In terms of reputation, he's a Nobel laureate, well recognized. But the reason that his presentation resonated with me, and because I think it caught the attendees by surprise at the conference, and it fits into what a person I have a lot of respect for, Richard Duncan, is writing about. And Richard wrote the book Dollar Crisis, and then he wrote another one on the corruption of capitalism, a strategy to rebalance the global crisis. And now he's got a new one out called The New Depression, the breakdown of the paper money economy, where he talks about a lot of these ideas, but has a completely different set of solutions. And Stiglitz has that he brought up. The subject that he talked about is mercantilism doomed to fail, which is also quite a catchy caption, in China, Germany, and Japan, and the exhaustion of debtor countries. No news there to a lot of our listeners. What was your reaction to that presentation, John?
Well, my reaction was that the same as to a lot of what you hear from economists these days, which is basically an attempt to fix via new layers of bureaucracy and new rules things that economists and bankers and politicians broke in the past. You know, we had a system that worked pretty well called the classical gold standard back in the day, when trade balances adjusted automatically, because if you ran a deficit, you had to ship more gold to somebody else. And so you didn't need layer after layer of bureaucracy and new global reserve rules and global central banking rules and things like that in order to fix the system that worked with sound money and clear capital flows. And so what scares me is that these kinds of prescriptions where, okay, the system's not working, we've got some countries running surpluses and some countries running deficits, so let's penalize the guys who are running surpluses and help the guys who are running deficits and set up a global bureaucracy in order to police all of this. You know, to me that seems like creating a dictatorship, which is what we're headed for, you know, nation by nation, and doing it on an international level, when simplicity, a return to simplicity of sound money and constitutionally limited government and clear, unambiguous capital flows would be so much preferable. And you don't hear that out there anywhere other than from somebody like Ron Paul, who, you know, gets 5 or 7% of the U.S. vote in the presidential elections when he runs. And otherwise, there's nobody talking about that. Many more people are talking about things like what Professor Stiglitz is proposing, which would be, I think, an attempt to fix things that didn't need to be broken in the first place, and at a cost of a global dictatorship. So the short answer is that this scares me. I would much rather see a return to simplicity.
Kind of thinking it comes from frankly, a bureaucrat, where centralized controls, more regulatories, more policing. We all know we need a better reserve currency for the globe, but how that would be addressed. So I didn't find any crisp new ideas on how to solve the problem, but at least I was glad to see that in many cases he was raising some central issues that need to be raised. And for some of our listeners that didn't have a chance, I'll just step through a couple of the slides. The one I have up here, as Stiglitz points out, the obvious but somehow not appreciated fact that exports and import is a net-sum game. And so if you are in Asian countries with export strategy, it comes at the expense of growth potential in other countries. And it doesn't mean that total growth doesn't grow, but that your share of the pie changes it, so it's not always 100%. And or so it's always rather, so it's always 100%. The central problem, which he's trying to point out here in this slide, is if you are on the losing side, how do you continue to pay for the export? Eventually lead to reduced demand consumption as the squeeze on financing is felt. And this is the foundation to me, John, for beggar thy neighbor policies, which I wrote about a couple of years ago, which leads to trade wars, which leads to protectionism, which leads to currency wars. Nothing new in there. But on this one I have up now here, which it was one of his slides on the deficit of last resort and the position that the United States is now put itself in. While the U.S. can do this because it's the world's reserve currency and as such controls the printing press, but in my writing, I described this whole thing that he was trying to do as a symbiotic relationship between two strategies. It was in a paper I wrote called An Economic Death Spiral Has Been Triggered. And the net of what I was trying to spell out in describing what he's saying here is we have a symbiotic relationship between two strategies. One's this Asian mercantilism strategy, and the other's a U.S. dollar reserve currency strategy. You know what? For nearly 30 years, we've had these two global strategies working in a symbiotic fashion that has created basically a virtuous economic growth spiral. Unfortunately, the economic underpinnings were flawed, and as a consequence, we now have this virtuous cycle has ended, and it's now in the process of reversing and becoming a vicious downward economic spiral. And the two strategies have worked in harmony because they fed off each other. Each reinforced the other. But however, today the realities of debt saturation has brought it to an end. And one of the two global strategies enabled the Asian tigers to emerge and grow to the extent that they are now, the manufacturing and potential economic engine of the world, was because of this mercantile strategy. But the other allowed the U.S., which is this reserve currency strategy, as I call it, to live far beyond its means with massive fiscal deficits, chronic trade imbalances, as Tiglitz points out, and more recently, current account imbalances. So the U.S. during this period has gone from being the richest country in the face of the globe to the biggest debtor. These imbalances are obviously not sustainable, but Stiglitz didn't give us any solution that I think is satisfactory here.
Feels to me like it's obvious that in a fiat currency world where you've got some countries just printing huge amounts of new, make-believe paper and giving it to other countries in return for real stuff, that you're going to build up imbalances which will eventually cause the system to implode. So, this isn't mysterious. This is exactly what you would expect given the system that we set up in 1971 when the U.S. took the world off the gold standard. And so, we've got countries that have been running massive trade deficits for a long time, others who have been running surpluses and building up foreign exchange reserves. But now the countries who've built up the foreign exchange reserves are going to get stiffed by the deficit countries having to depreciate their currencies. And so basically, as we talked a couple of sessions ago about vendor financing within the Eurozone, the whole world has been engaging in this, with Asia basically lending us money to buy their stuff. And now they're going to find out that the money that we pay them back is going to be worth a lot less. So their foreign exchange reserves are going to turn out to be an illusion when the dollar is depreciated really dramatically in order to cover the debts that we've taken on. So, none of this is mysterious, and it wouldn't happen if we were dealing with real money. In other words, if we were limited in the amount that we could borrow because people want gold instead of dollars, and the supply of gold in the world is only going up by 2% a year, then we wouldn't have been able to run these massive trade deficits. We wouldn't have been able to build up this debt, and we wouldn't be in the bad shape that we're in right now. And so this is not mercantilism, it's fiat currency, and it's the inevitable result of giving governments printing presses and allowing them to just make up wealth, quote unquote, out of thin air. You're going to get these imbalances. You're going to have a collapse at the end of the imbalance buildup, and that's all there is to it. And that's where we are right now.
When I was writing that paper I was referring to, and as I recall, I had 5 key reasons why this, as I was saying earlier, the symbiotic relationship couldn't sustain itself, and why the imbalances themselves were going to break down. And I'm not talking about just from the obvious things that we've discussed in the previous tapes, but one, though the Asian export strategy is an export trade imbalance game, and the U.S. dollar reserve strategy to me is a volume trade game, both were centered on global trade. And the U.S. won by increased global trade and the growing requirement for the U.S. dollar it required, whereas the dollars that could be increased to pay for military industrial complex without increasing taxation and used as reserves for the global banking growth. Asia won by getting an ever-increasing share of growing volume of trade. Second, the U.S. as a 70% consumption economy needed cheap financing to sustain its insatiable consumption. Asia needed consumption to absorb its growing exports. Then three, the U.S. needed a strong dollar to attract financing for its debt, but Asia saw U.S. debt as a store for its growing reserves that additionally reduced financing costs for its export products. In a way, Asia was offering, as we said, a form of exactly a vendor financing or this layaway financing we were talking about. And a fourth I saw was that the U.S. corporations, and these are all changing if you think about them. The U.S. corporations saw offshoring, outsourcing, right-sizing as a major productivity improvement. The Asian mercantile strategy offered American corporations an opportunity to significantly increase profitability, while Asia needed ever-increasing larger market segments to penetrate. And U.S. corporations brought the know-how, the branding, the capital to the Asian economies who desperately needed these strengths to employ unskilled populations, increase standards of living, reduce the always present potential social unrest which you have when you have 50 million people a year leaving the rice paddies and going to cities looking for work. And the fifth was that the U.S. economy, which has shifted from an industrial economy to a services economy, was quickly becoming a financial economy with 44% of the stock market being financials. The financial economy needed increasing capital inflows to sustain itself. So those symbiotic relationships have worked, but if you go through them, every one of those, John, has stopped and reversed. And it's because, as you said, when you have a fiat currency system and you just keep expanding it, at some point you can't expand it, and that's when it starts to break down. And that's exactly what's happening. Unfortunately, and here's the rub, instead of it becoming a virtuous upward cycle, it becomes a vicious downward spiral. And once it starts, it's darn impossible to stop.
Yeah. See, Gordon, all the things you listed there would have happened in a sound money system. In other words, we would have had trade relationships with Asia that were mutually beneficial. But it couldn't have happened on this scale of imbalance without us having a printing press and the rest of the world being willing to take unlimited numbers of dollars. And that's the make-believe part of this. The idea that these computer bits and pieces of paper actually have some value is what is going to end up destroying the system that we build up, because we've allowed, by believing the illusion that paper currency is somehow wealth, we've allowed huge imbalances to build up, incredible amounts of debt all over the world, and now this debt has to be wiped out. And so, it's going to manifest itself to an extent in a reversal out of our trade relationship with Asia, where the surpluses that they've generated all these years are going to turn out to be illusory because they've got it invested in dollars, which are going to become a lot less valuable, and our trade deficits, the debt we build up, will also be partially illusory because we're going to inflate away the currency that we're going to pay this debt back in. So that's what's coming, and we're at the point where the old relationships aren't really working anymore, but we haven't hit the point where we reverse them out really aggressively. But that's coming.
John, I have up global reforms that Stiglitz came to a conclusion and said we need it. Do you have drawn any conclusions on where we go from here, how we begin to approach some of the problems that we now have? Is there a roadmap that is possible going forward?
Well, there's no painless roadmap. You have to wipe out excessive debt when you take it on, and that's all there is to it. So either we inflate it away or we collapse under the weight of it, which means for 10 years we have a global nightmare, and that is completely unavoidable. The only choice we have is the kind of nightmare that we live through. And as for the reforms that Professor Stiglitz recommends here, I would say that they're exactly the opposite of what a successful global economy should see, and that would be devolution of power to member states, all of which have to exist under a sound money regime. In other words, go back to some kind of it doesn't have to be necessarily a gold standard, but some kind of a standard where all national currencies are measured against something that governments can't inflate away on a printing press. And that forces everybody to live under the same basic standard, and forces everybody to live within their means. So that's the adjustment process will be different for different places, but everybody's adjusting to the same economic environment and eventually becoming healthier for it. And, which means go back to some kind of a sound money standard, some kind of a constitutional standard in most countries that limit the power of the central government and increase the power of individuals over their own lives. So, my argument would be to go back to the original constitutional structure of the US with sound money and limited government and have that spread to the rest of the world. That would create a much sounder global financial system than any of these one-size-fits-all global bureaucracies that you see tossed around out there now via the United Nations or the World Bank or the International Monetary Fund. These things will just devolve into some kind of a dictatorship within a decade of being set up.
When they formed EU and the role and the definition for the ECB, the Germans and others were so strong because of their experience, Weimar Republic, of currency debasement, that they wouldn't even allow the ECB to have the same role as the Federal Reserve by definition. And we're clearly seeing when push comes to shove that quickly changes, and it's always been the case. So, so it doesn't work. So getting the politicians and the leaders to agree to coming back to something that's solid, a solid currency foundation that can't be printed, is almost, to me, John, an impossible project that will never happen. And what happens, and what I've learned with politicians, is they wait for and are dependent on a crisis to happen. And the crisis always gives them the foundation in which to make changes that nobody would accept. The problem is when that happens, they don't take advantage and point us in the right direction. But it'll take a crisis to get us back to a firm foundation where money has some value and is truly a store of value. And I mentioned Richard Duncan earlier when we first started. I would say he's a hard money kind of guy. He's come out of the conclusion where you said there was basically two options. Either we write off the debt or we inflate it away. And he's come out of the hole that he believes now the only solution and the right solution is in fact to inflate it away. And interestingly enough, in inflating it away, his argument is it will buy the governments enough time, if they could just use it properly, to take this false money and false wealth and plow it into things that will in fact at least point societies in the right growth directions. And he was talking about growth economics and real growth, not false growth where government spending is a dominant part of the GDP. So I'm starting to see hard kind of guys saying, look, the devastation and the ramifications of writing off this debt is so massive. The abilities to actually make it happen logistically are not possible. That it is the only solution. It is the only direction. I'm skeptical that we'd ever get, with having said earlier, get any politicians to, in fact, then implement the right kinds of policies. Just an interesting point I saw as a contrast here. Have you read any of Richard's works?
No, I haven't. But as you describe it, it fits perfectly with what's coming, because when anybody who depends on getting elected or making money from consumer sales or anything like that looks at our alternatives, clearly they're going to choose inflation because that keeps the game going for a while. And so the public policy options are always going to be skewed towards the thing that's least painful in the short run, which is always going to be print a lot more money and keep the game going for a while. But that's based on one central fallacy that will come back to bite us pretty soon, and that is that that's like a thermostat. You can increase inflation to 4%, and the system will keep on going in a linear fashion when inflation goes from 4% to 5%. When what will really happen is that we'll go nonlinear out there at some point, where we'll just have a global currency crisis in which nobody wants to hold these currencies, which are clearly being inflated away by explicit public policy, and they just dump the currencies all at once. And then you see the system just collapse in one way or another. You see it go nonlinear, and you see a catastrophic collapse of the banking system, or the sovereign debt system, or consumer spending, or all of the above, and nobody wants to hold these currencies that are being systematically inflated anymore, and that's what's coming. I mean, we'll clearly try to inflate away the debts that we've taken on, but that'll only work as long as people will take the currencies that we're printing. And as soon as they won't, the system falls apart. And so we're going to get that deflationary crash out there somewhere. The only question is it preceded by an inflationary spike? And I suspect it will be, just because that's, like you said, that's the public policy that even hard money guys are coming to accept as the only alternative that's feasible right now.
I strongly believe the government's already adopted that, but they're under the mistaken belief and perception that they can control the rate of this inflation. I'm not talking about how it's measured, but inflation. And you make an absolutely sound point, John. And the way I describe it is you don't move from high and elevated inflation to hyperinflation because of monetary policy and increasing supply demand push. Why it changes, why hyperinflation suddenly happens, why it suddenly happens is because people lose confidence. It becomes a sentiment shift, and where the confidence comes is in the lack of confidence in the currency, in the denomination of the store of value of what it is that you have to do your purchasing in prices that are going up. And when that shifts, whether you want to call it suddenly dramatic money and velocity, it's an attitude, and it seems like it comes out of nowhere and is always sudden. The most recent example that I can think of, and there are many of them, is in my readings in Germany, how quickly and suddenly it happened. And it's not, you measure this, John, in days and weeks. It's not measured in months and quarters. So when that's going to be, nobody will know for sure, because it's like the measurement of sentiment. And as Alan Greenspan once said, he said of all the things that if he could do better monetary policy, if he could understand, is what makes sentiment change. Because he says, if I could understand that, I could do so much more, but it just changes out of nowhere. And so I think we're agreeing to the same thing, maybe from a little different perspective. We need to wrap for today. Any last comments you'd like to make?
No, I think we've covered things very well.
John, how would our listeners find out more about your work and your site and your writings?
I run dollarcollapse.com, which covers a lot of the stuff we've talked about today in a updated continuously form.
Thanks, John, and we'll hopefully be back together in next month, when I'm sure we'll have too much to talk about again. Talk to you then.
Yeah. Thanks, Gordon. Look forward to it.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.